Germany may be on the brink of recession. Data released shows that the sovereign debt crisis caused the economy to contract in the final quarter of 2011. Europe's largest economy shrank roughly a quarter percentage point in the fourth quarter, but Berlin continues to outperform its peers. For the year, Germany grew 3% thanks to domestic consumption and strong exports, which grew over 8%. Private consumption rose while the country's unemployment levels shrank. All right, now for a perspective on the Eurozone crisis, we've got Tom Vosa, who is Head of Market Economics at National Australia Bank, who joins us on the show from London. Now, Tom, to begin with, Germany grew 3% in 2011, with exports alone rising over 8%. Do you believe Europe's largest economy can sustain this growth for the year 2012, or do you believe the burden of the euro area could drag the country into recession as well this year?
We actually think that Germany should just about be able to avoid recession. It's not going to grow at 3% this year. It grew at 3.7% in 2010, a post-unification high. 3% this year. At the moment, we think growth in 2012 will be less than 1%. Now, there are two reasons for this. The first is you're not going to grow as rapidly as it has done in the past. Simply, things start to slow down. Second, we have the cumulative impact of the ECB rate increases early last year. They were reversed at the very end of 2011, but that's going to cause some slowdown in the economy. Remember, though, the German labour market remains extremely robust. We have unemployment rates at post-unification lows, and exports are, of course, being held up by the very weak value of the euro. The benefit to Germany of some of this sort of ongoing sovereign debt crisis is that the single currency is undervalued versus the US dollar and certainly sterling, and that's allowed German exports to grow very strongly. We're seeing profit margins for most large German exporters around 20%, and that's going to keep the economy growing. We think it will avoid a recession, but perhaps growth of less than 1% this year, which will be a marked slowdown.
Now, Tom, Greece has about $14 billion in principal repayment that is due in mid-March. They don't have the money and therefore need to push through a restructuring exercise before the end of this month. Now, even if the restructuring exercise were to be voluntary with the support of all lenders, what's to prevent a credit event from taking place that will trigger credit default swaps and then ultimately lead to a full-blown crisis?
I think it's fair to say that within the European Union there has been a great interest in ensuring that a credit event does not happen. I think for some European governments they would see this as actually rewarding sort of the hedge funds who have taken and the speculators who have taken positions on Greek debt. So heaven and earth is being moved to precisely avoid that from happening. This is why the agreement is perceived to be voluntary, with the ECB excluded. How do we get a credit event in Greece? We need to look at Greece exiting the euro. Any movement out of the single currency area would immediately start to trigger a credit event, which is why, of course, we have heard the Czech central bank governor in recent weeks discuss the fact that either Greece needs an awful lot of money fairly soon, or it needs to leave the eurozone. It's only we believe in a full Greek exit from the eurozone that we are likely to get a credit event. European governments do not want a credit event to happen in Greece. My suspicion is that they will manage to avoid it, but if they do so, it really will be by the skin of their teeth.